All right. Well, it is 4 o'clock. I think a couple other people will be straggling in, but I think we might as well get started. And Naval, Sunny, Sergey, you guys all have you're up and running?
Antonio's here as well.
Oh, there we go. Great. Antonio made it. So I think we have a couple who'll be straggling. But let me go ahead and start with introducing the folks who are going to be on the panel and what we're going to be talking about today. Well, the panel, let's say the happy hour. So, real briefly, I'm Haseeb Qureshi. I'm managing partner of Dragonfly Capital, which is a global crypto fund. And today we're going to be talking about DEXs. So I'm gonna just go around and let everybody very briefly introduce themselves, and then we'll start by just briefly explaining what DEXs are, and then we'll go into some of the more interesting topics about how DEXs are evolving today. So Naval, why don't you go?
Yeah, I'm Naval, Twitter provocateur. I don't know, what the hell am I? Human. Reporting for duty. I'm in. Okay, what am I? I founded AngelList. I tweet on Twitter, and I like Web3 and crypto.
Amazing. All right, Dan.
Hi, I'm Dan. I'm head of research at Paradigm. I work closely with a lot of portfolio companies in here, including DYDX, hi Antonio, and Uniswap. So excited to and Osmosis. So excited to chat.
Beautiful. Antonio, you want to go up?
Hey guys, I'm Antonio, the founder and CEO of DYDX. We are the largest decentralized exchange in the world by trading volume, and we're focused on financial derivative products.
Boom, just claiming the high ground right there.
Tarun. Tarun, you alive? All right, we're going to skip Tarun. Sunny.
Hey guys, my name is Sunny. I'm one of the co-founders of Osmosis. I've been working in the Cosmos ecosystem for about 4.5 years, really focused in on blockchain interoperability, and now figuring out how to make DeFi cross-chain.
And Sergey?
Hey guys, this is Sergey. My background is distributed systems, cryptography. I'm currently a co-founder and CEO of AngelList, which is an interoperability network.
Cool. And it seems we have, great. Maki just joined us. Maki, why don't you introduce yourself?
Hello, everyone. SushiSwap co-founder and now advisor. I'm Maki, and I just love everything DeFi.
And Tarun, if you make it?
Hey,
okay, there you are.
Yes, can you hear me? Yeah. Hey, I'm Tarun, founder and CEO of Gauntlet. We sort of do risk and incentive management for a bunch of protocols. Also co-run Robot Ventures. Then a bunch of academic papers on AMMs.
Great. So there are a lot of folks here, and I imagine there's a mixture of knowledge levels when it comes to DEXs. So I think it's probably worth first defining our terms. What exactly is a DEX? And also probably worth asking the question, which we might not have consensus on, is what is not a DEX? That some people might think is a DEX. So I think I'm going to elect Dan Robinson to take a crack at this question.
Sure. So DEX stands for, I'm going to take a crack certainly at the first question. DEX stands for Decentralized Exchange. And generally it's a decentralized application on typically on a blockchain that allows people to trade one asset for another. And there are two, broadly speaking, categories of DEXs that I think we've seen in crypto to date. And those are order book-based ones that work a little bit more like a central limit order book, is operated by Coinbase or other centralized exchanges. And then AMMs, where you have a pool of liquidity providers that are providing according to some strategy, and then everyone who's trading is trading against them. So I wouldn't say exactly. In the fight. I think both of them, I hope, do great things. And I think Uniswap V3 actually combines some elements of both of them. So it isn't necessarily pure AMM or pure order book. And then for what's not a DEX, I don't know, everything's a DEX. I'm not sure what you're looking for there.
Well, it's funny because, the history of DEXs has gone through it's sort of gone through phases, right? So Dex has started with, I mean, there have been Dexes before Ether Delta, but Ether Delta was the first major one on Ethereum. And that was an order book exchange where all the orders were actually on chain. And then we went through this massive AMM revolution, which, Maki and Dan Robinson were big parts of that revolution. And it used to be, but until relatively recently, almost all the volume in decentralized exchanges were happening on these automated market makers. And then you've got Uniswap v3, which, Robinson, you just alluded to, and you've got DYDX, which is, Antonio is responsible for, which have now resurged in volume that is moving back to the order book model. And so how do you guys think about the kind of the yin and yang of the order book versus the automated market maker? And maybe also maybe worth defining what exactly is an AMM and how it differs from the order book model. I think Tarun died. Otherwise, I'd ask. Okay, yeah, Antonio, why don't you take it?
Yeah, so I may be a little bit biased here. As Haseeb said, DYDX is an order book-based decentralized exchange. So welcome Maki and Dan to respond to this. Maybe first, like you said, defining what is an order book-based model versus what is an automated market maker. An order book-based model based on a central limit order book, basically makers can place bids or asks to buy or sell a certain asset at different prices, and then takers can come in and take that liquidity. They basically rely on market makers for the most part and sort of professional liquidity providers to provide liquidity. And it's really similar to how a Coinbase, FTX, Binance, or pretty much any other traditional exchange works. Automated market makers, on the other hand, are based on an algorithm. So effectively, the smart contract has some algorithmic way in which liquidity providers can provide liquidity, and then takers can come and trade effectively against a pool of capital that's trading based on this algorithm. And kind of comparing and contrasting the advantages and trade-offs of the two, because I really do think there are trade-offs. I don't think one is objectively better than the other, and certain, ones are better for different use cases. Maybe I can just go through and give a bit of color on why DYDX is focused on order books rather than automated market makers. My hypothesis, at least, is that order books are better for providing liquidity on sort of the highest volume markets. So order books can translate a given amount of capital into much more liquidity than automated market makers can, and therefore can provide a better trading experience on just sort of the top markets that people are trading. I do think automated market makers are really innovative and are really good for providing liquidity on the long tail of markets. But I still think order books are probably better for providing liquidity on, call it like the top 100 to 200 markets. And the reason DYDX is focused on order books is that we believe that currently and far into the future, most of the volume in crypto will be on these top 100 to 200 markets. And that's why we're really focused on them.
Yeah, I generally agree. I think that the beauty of AMMs were that they were designed to really provide liquidity, being able to provide liquidity on these tail end assets, of which most of the crypto assets, at least back then, were. And it solved this really interesting problem where in a way it reduced the barriers to entry to getting liquidity on new assets. One of the cool things with crypto is we're getting a lot of assets being issued very early on in their lifetime of a product. And normally on order books, you typically need to go hire professional market makers to come in and market make for your assets and provide liquidity. And that just provides a really high barrier of entry for very small products or very small protocols that want to just get some base liquidity for their protocol right away. And so that's sort of AMMs really solve this problem for these new this tail end of assets, which is what most of crypto was and still is today. Because the thing is, you don't know what the tail end assets of today are going to be the blue chips of next year, right? So I think that a lot of the blue chips today may not have ever existed if they weren't AMMs providing them liquidity at that early stages.
So I'm curious why you think it's taken so long for the order book model to become successful via DYDX. I mean, DYDX and /UniV3 being this kind of hybrid order book AMM model. Why do you think it's only now that they've started working? I'm curious if you guys have any theories.
I mean, one of the big things was the lack of scalability earlier. So, it's basically impossible to run a proper order book on like mainnet Ethereum. And so that's why like DYDX was able to use like, roll-ups and things like that, where you have the scalability to run these things. So I think honestly, one of the biggest drawbacks was the technical limitations earlier.
Yeah, I think they're kind of solving different problems as well. Really what we're trying to do at DYDX and our highest level goal is to do things that are similar to what centralized exchanges have done, trade derivative products, trade perpetuals, trade the markets that are already being traded on centralized exchanges, but do it better than they're doing. So we're really directly attacking that market, whereas I think AMMs and specifically Uniswap, a la like a year ago, they really created this kind of new market for themselves, where they were the first ones to be able to offer trading of a lot of these long tail assets, that there was a huge amount of demand to trade, and that allowed them to grow in a huge way, and also echo everything that was said about the scalability as well.
So I don't think that, I think I agree with people that the long tail is an important part of the story. I don't think it's the whole story, or even like more than half of the story, because if you take, say, stable trading pairs, those are also by far dominated by automated market makers, particularly Curve and Uniswap v3. And I think there's advantages that are beyond just these are some of the most like liquid, most head of the Curve pairs against each other. And I think I'm going to give you sort of the boring technical answer, which is that I think two of the big advantages that Uniswap v3 specifically has over central limit order books. One is just continuity of prices, where you just can provide prices at much higher granularity, and I think that's really useful for the stables pairs, especially where we're seeing that actually like even like a pool where there's sort of 1 BIP granularity of price is just like it's really valuable to have. And the other is the ability to there's sort of a massive efficiency gain from not having to replace an order that's been hit. Where orders just naturally flip to become, buy orders naturally flip to become sell orders. That avoids the need for market makers to basically replace an order when after one has been hit, or when the prices move down, sort of like to put in a sell order behind it. And I think that's just sort of been a big advantage in terms of efficiency for DEXs. So again, like these are two areas where like Uniswap v3 gets rid of a lot of the stuff that Uniswap v2 changed about order books. It's a lot more similar to central limit order books, but I think those two changes have really had a high impact on it.
Before we get too much into the details, can I just, for the general audience here, I just want to also just look at one or two things about these decentralized exchanges. First is the KYC situation with them, and how we think that's going to evolve over time, especially with the new infrastructure bill, because my understanding is that there's no KYC on a true DEX. And a second would be like how much of these DEXs are really decentralized, because some of the front ends are run by US-based companies. Are they going to have to basically start putting KYC in front, or is all of it going to be truly decentralized, like an IPFS hosted web page or some kind of a Web3 hosted web page?
Yeah, well, I think one thing that you have to realize that all the DEXs are built on open systems, right? So what does that mean, right? Like, we're not talking about a single DEX. We're talking about many different DEXs that were possible because they're designed on open systems, and you have this access to user bases and liquidity and kind of distribution from day one, right? So what makes DEXs popular and really kind of stand against centralized exchanges is the fact that anybody can come in, anybody can play with it, and anybody can interact with it, right? And so I think the KYC requirements may come in, but they may come in only from the front end. From a technical perspective, just because the technology is open and technology is sort of accessible to everybody, I think you're always going to have this distribution angle.
So you're basically saying, so just to be very practical, like if somebody says, let's say the main front end for Uniswap is hosted out of New York, and New York says, hey, you got to KYC everybody, then someone in Moldova could set up a front end tomorrow that's a non-KYC front end.
That's exactly, yeah.
Into the exact same liquidity pool.
Yeah, exactly, right. And I think even if you look at Uniswap, a lot of the kind of interaction with it doesn't come from a single front end, right? There's all kinds of APIs, there's all kinds of contracts and other applications that are built on top of these open systems that are interacting with it at the same time. So that's incredibly powerful.
So for Osmosis, we're taking actually a very interesting approach on the front ends, because we do recognize that is actually one of the biggest points of centralization right now. And so what we're actually doing, but at the same time, there's many projects who are taking the approach of like having many front ends that are available. UX hurdles as well as security issues as well. So one of the things that we're really interested in doing and working on right now is there's a Cosmos project called Akash Network, which is sort of this like AWS style market on the blockchain. And what we're actually working on is transitioning the official front end of Osmosis to be hosted on Akash Network, paid for from the Osmosis community pool. So it's essentially the DAO itself is paying for the front end hosting, and it will own an ENS name that points to it. And that way, the only way to actually upgrade the front end is to make a governance proposal, to the DAO and request the DAO to like upgrade the deployment. So basically, we via this like method, we basically get the front end itself to be controlled by the DAO in the same way that the protocol code base is as well.
And the DAO is getting its funding from fees or somewhere else?
Right. So, I mean, yeah. So in Osmosis, the DAO gets a portion of all the inflation. So 5% of all inflation is put into this thing called the community pool, which then the DAO can choose to spend on whatever it wants.
And for those of you who are new to this, DAO is distributed autonomous organization. It's like a series of smart contracts living on the blockchain, and people vote in it with their tokens to adjudicate how the network is run. So you can think of it like a co-op where a token buys you a vote.
So, I mean, at a high level, DEXs sound kind of scary. And as you alluded to, Naval, there's a very uncertain regulatory regime around DEXs today. And so I think it's likely, there are a few things in DeFi, actually, there aren't a lot in the way of DEXs that have KYC, but we're starting to see some KYC lending pools actually show up, which is another of the big activities that we see a lot on DeFi. And I'm curious what people think is going to be the long-term trajectory if we start to see more and more regulatory oversight over exchanges. You alluded, Sergey, earlier to the idea that the front ends may be controlled, but the protocols themselves will not be. I think it's also very likely that eventually we see a bifurcation where there's sort of the shadow global DeFi, which is the one that doesn't require KYC, meaning that anybody can use it from anywhere in the world. Nobody has to know who you are. And then there's the sort of lit DeFi, which is the DeFi that is, everybody has to, register with their identity, and the government knows who you are. And this pool of liquidity is going to be separated from the kind of global, the sort of global decentralized market, which is going to be distinct. Curious what you guys think about that vision.
Kind of disagree with that, actually. I am not a huge fan of these new just sort of permission DeFi pools that seem to be popping up. I really think that sort of the end state of DeFi is that there will be these censorship-resistant products that everyone can use. And I think it's really important that they do remain open source and accessible to more people in more places. I really think that the front ends being decentralized problem is a really solvable technical problem. Yeah, you can host right now you can host a front end on IPFS or some sort of distributed file store. It's not super performant right now, but again, that's a solvable technical problem. I guess to me, it really seems like it doesn't make sense to bifurcate the liquidity, sort of the style or like the end state of the world that you were talking about, Haseeb. It really seems like some way, somehow, just the bigger financial institutions, which do care more about regulation, will find a way to trade on the most liquid, sort of best products in the world that are out there. And I think that's already happening a lot with decentralized exchanges right now. Like we at DYDX have been having a lot of conversations with market makers who have historically been really standoffish towards DeFi over the years. But right now, because there's obviously a huge boom in decentralized exchanges in general, a lot of them are really interested in getting spun up, using different legal structures, things like that, to be able to trade on these platforms that can drive real value for them. So I think as long as there are these platforms that have liquidity that can drive real value for them, traders will find a way to trade on the best products, or financial users will find a way to use the best financial products. And I think the best financial products will be those that are
data about their transactions before they're able to execute them. And that's why we've been building this solution called threshold encryption, which is a way of making sure all transactions are encrypted before, and they only get decrypted once they've been committed into a block and finalized, and it's impossible to front run. So that's like one of the main privacy things that we're focused on. And then, the other big one that we learned from people is, from talking to traders on centralized exchanges, they've told us that, one of the biggest issues that they have with trading on decentralized exchanges is that they will leak their entire trading strategies. Because, when you have on normal blockchains today, you have a account and you can see every transaction that's coming from a specific account. And so what we're actually working on is taking the privacy technology from Zcash, the zero knowledge shielded pools, and putting them into Osmosis, and then having all users keep all their assets in the shielded pool, and then they do trades, but you can't tell that every trade is coming from the same address or not. And so kind of like, what Haseeb was saying, it was like, do privacy coins have a future? I mean, it depends on what you mean by that, because I think what's going to end up happening is going in the future, everything is going to be a privacy coin. Like having the privacy technology that was invented by some of these early privacy coins is going to basically populate a spread and be available for like every crypto asset.
One other thing I guess I'd add about privacy in DeFi that's kind of different than privacy at the coin level is that, there's a sense in which all financial products always need to separate public and private data. You don't really have a financial product like a DEX where all of the data is private. And what I mean by that is that if you were using a DEX and you didn't see the price and you could not figure out the price from the current state on the blockchain, then you probably wouldn't trade against it, right? It's basically not guaranteeing you any sort of consistency on price, execution, quantity, fees, etc. So there always has to be some public revelation mechanism that reveals price, even if it hides balances or it hides other features. But the problem is the threat model is now quite different. Now you have to think about, hey, can an adversary take that public data and infer something about me from the public data, even though they don't know my private data, like my balances, which trades are mine, etc. And that design space has been basically completely not tackled and is still sort of, I think there's sort of the heavy-handed approach of throw as much zero-knowledge cryptography as possible, but then, you sort of don't exactly guarantee that you can't infer things from the public data. Or there's sort of other more statistical approaches. And I think that over the next coming years, we'll see much more of that throughout DeFi, because that's clearly, the threat model that we use for the privacy coins themselves is quite different than the threat model that you would need for something where you are having to reveal a bunch of public components that are computations based on users' data.
Yeah, so I think a few things just to add to this. So if you take a step back, whenever we're talking about privacy, we have to define what we mean, right? There is application privacy that could refer to the application like code that may need to be private if you're trying to like protect your trading strategy or something like that. There's data privacy about the actual trades or information that goes into these applications. And then there's a user or identity privacy, right? So I'm a user, I want to interact with this application, and I want my identity to be like hidden somehow or kind of protected in some way. And so I think for all of these privacy levels, you do need different technology, and technology itself kind of would give you certain implications. And I think one thing just to realize that whenever we're talking about privacy, often, no matter kind of what technology you're applying, you're actually breaking some parts of composability, right? So it's not always the case. It depends like what technology you're using, like multi-party cryptography or like zero knowledge proof. But in general, if you have kind of a private data or private applications, then composing it and interacting with that data or application becomes a whole other level. Like it becomes a technical barrier. And so that's just one trade-off that we have to think about whenever we're talking about privacy.
Well, I'd love to get Maki's perspective on this question, because actually on this panel, Maki is the only person who's actually pseudonymous. Maki, of course, is not his real name, and we don't know who he is, but he is one of the co-creators, call it, of SushiSwap, which is one of the largest exchanges, decentralized exchanges on Ethereum. So Maki, how do you think about privacy? Obviously, there's privacy in the, okay, can I see the price? Can I see the order book? Can I see the mempool? And there's privacy in terms of you and your financial ownership being private from your real world identity.
Yeah, I think it's going to be very interesting to see if we're going to be moving into like actually like a fully DEX that's going to be, powered by, let's say, I don't know, like a privacy solution like Tornado, with baked in, like privacy inside, or something like more like a blockchain, like, what Menta or Secret are doing. It's going to be quite interesting to see where the traction goes, if it's going to be fueled by, like incentives or not. I think overall, like, privacy is as good as how you can kind of get out. Right now, like, there is actually checkpoints everywhere in the system if you want to go with intermediaries, right? If I do want to get like fiat for my crypto and I still rely on P2P with like actual individuals, like, that's great. But if you have to go through intermediaries, then that's why you don't even need to have like KYC necessarily, like at the DEX level. I think at some point, when everyone's going to go back on the old rails, you're going to have to question like how to do it properly. And I can tell you firsthand, it is not as easy as people think. And of course, like, if you want to be law-abiding citizen and so on, then even right now, in the context of crypto and so on, like, institution are actually very adversarial. And if you are dealing with dexes, with Tornado or else, like, you actually are on a list, and you will be potentially in trouble, like, unless you can show that everything is right and beautiful. In the future, like, I don't think this is going to go away. Potentially, like, we were talking about KYC earlier and AML, potentially, like, for dexes and front end. I think, like, some are just going to harden even more. Like, I don't see why, like, anyone is not potentially, incentivizing third-party front ends at this point. It's going to be like something that's going to be happening more and more. I think one of the best example right now in the game is Liquidity. They've been doing like a tremendously good job at it, and maybe we're going to see like more and more kind of front end hosted on things like Airweave, VPFS, and so on. It's just like it has to, or people are going to use like third-party aggregators like CowSwap, 1inch, Matcha, and so on. I think it's really going to boil down to this, and every kind of protocol builders like Sushi, Uniswap, Banker, Balancer, and so on, Curve, they're all going to actually be competing at the very like protocol layer, where users are not even going to be interacting with them. Potentially, like, there's going to be onboarding like just with wallets to long term, like, depending how this goes, and potentially with the scalability issues like with layer 2. I think we saw like this week, if I'm not wrong, Argent announced that they were going to be running on ZK rollups. I think ZK Sync. This is actually where I think like the futures of dexes and so on are probably going to move into, more like being abstracted forward and so on. Leaving kind of, I guess, all of the liquidity up for LPs, which are usually like dominated by whales and like high net worth kind of individuals. So yeah, we'll see how it goes, but I think privacy per se is going to be a spectrum, and it's going to be not just like one implementation that's going to win potentially. I'm personally thinking that's going to be more like a blockchain oriented potentially, but we'll see. I mean, you can't you can't easily speculate on the future of it until the projects are out and in the wild. Even Uni V2, for example, had quite a hard time to gain traction initially. Like, I mean, not hard time, but to have the level of depth that there is today, like Sushi had to come in and put a carrot with incentives for LP to actually opt in, and then that's what kind of triggered this whole kind of renaissance, and now it's viable to actually have Dexes out there. Because if you remember correctly, there was at most over 100 and 200 million, and a lot of the folks active traders were not considering any of these dexes as relevant, mostly because they couldn't trade size. FTX, but I mean Alameda Research, Three Arrows were very not bearish, but it was a joke. It was like a desert town. Now today, everyone is using dexes because they're it's to the point where the gas fees, the arbitrage opportunities that have been unlocked by all these other protocols competing for liquidity and best price. We could even talk about MEV, but I don't want to go on and on.
Let's stay away from MEV.
You give me a hand, and I take the whole.
We're gonna go too deep if we try to touch MEV.
One thing I'm sorry. One thing I just wanted to add to Maki's point about, you're using dexes and there's this adversarial counterpart thing because, hey, you might have to go to a fiat on-ramp or an exchange. I think the biggest innovation that we'll probably see for privacy over the next 5 years is private bridges or some form of weak privacy on bridges between blockchains, because that would basically help people get off of having to go through the centralized intermediary, which I think is the source of a lot of some of the things that Maki was sort of hinting at.
Well, so maybe we should define what that means, because I imagine for many people in this audience, they're not familiar with how the cross-chain universe has evolved in the last few years. So just to give a very brief high-level overview, back, call it 2-3 years ago, Ethereum was the only place where anything in DeFi was happening, and every other blockchain was essentially a ghost town. And really in the last year and a half, we've seen this revolution of tons and tons of chains popping up that now host their own little DeFi ecosystems. And there's a lot of connectivity now between Ethereum, which is the oldest and kind of most well-capitalized and most robust DeFi ecosystem, and all these new ecosystems that are popping up like Solana, like Avalanche, like Cosmos and Terra, and so on and so forth. So, Sergey and Sunny, both of you guys work in the cross-chain DeFi environment where you guys are connecting up different chains that do DeFi and making them talk to each other. It's almost like an internet of blockchains that are able to seamlessly transfer value to each other and intercommunicate. How do you guys see DeFi changing from where it was a year or two ago when it was mostly on Ethereum to now this new world where we're seeing more and more DeFi pop up on other blockchains?
Yeah, so I think for me, if you look at the ecosystem in general, like you said, we have now all these different dexes that are popping up across different blockchains. But as a user, the experience from going from one ecosystem to another is just incredibly painful, right? Like you have to go through some bridge. That bridge, you have to understand how it works, pay some transaction fees along the way, take some security assumptions or risks in that process, and so on and so forth. So I think the whole space is just incredibly fragmented right now. And I think over the coming years, what we're going to see is all these different ecosystems starting to become glued together in some sense through various protocols, through various interoperability layers, and so on and so forth. And the eventual goal that I think we need to get to is that if you're a user and you have an asset in any of these ecosystems and you see an interest in DEX on another ecosystem, you should be able to go and use it. Right, and there's all kinds of layers of protocols that are going to be happening under the hood, from both application layer to routing and kind of interoperability protocols that would make it happen. And so we're not there yet today. I think right now, like you said, you have to go through a bridge and so on and so forth. But I think that's what we're going to start seeing in the coming year or two more and more.
Yeah, I think underlying this is just a broader question, which in crypto, and this maybe takes the conversation to a little higher level, is are we living in a multi-chain future? And I think everyone who's up here implicitly thinks so. But it might be worth talking about that just for a moment for the audience, because it started out with Bitcoin, and then there are the Bitcoin maximalists. God bless them, right? The Spartans. They're very motivated, very high conviction. And then next came ETH, and then now there's a level of ETH maximalism, which is no, ETH's going to swallow it all. And now there's a bunch of other chains. You mentioned Solana, Ava, Near, et cetera, and there's even a coin maximalism going on against the NFT folks, right? Like, how can JPEGs have value? And even within NFTs, there's layers and layers of NFTs. Some people think only the community NFTs have value. Others think the art NFTs have value. Others think only the game NFTs have value. But so we're kind of in this exploding world where the moment we created digital real estate by making digital objects scarce, we started dividing them up in every possible way and assigning value across all of these things. So, what gives people here confidence that we're going to be in a multi-chain world where we're going to need to swap assets from, let's say, Solana DeFi to ETH DeFi versus just a winner-take-all world where, because of composability or network effects, everything collapses into ETH? I don't think there are any Bitcoin maxis on this stage.
Unfortunately, yeah. Go ahead, Antonio. No, you're good. Go ahead.
Okay, sure. So I think there's kind of two things around this. First of all, is just the pace of innovation in blockchain is extremely high. Obviously, I'm not the first to say that. But also there's a lot of trade-offs between building on different chains. Like, some chains may be more scalable, but sacrifice on decentralization. Some chains may have more privacy, so on and so forth. But I think what's unique about crypto is that the order of magnitude of these trade-offs is extremely, extremely high. Like, for example, if you're willing to sacrifice on some amount of decentralization, you could get 10, 100, maybe even 1,000 times better scalability, just as an example. And different people are building different things. So therefore, it makes sense to have different of these types of products built on different chains, because different trade-offs make sense for different products. So I think that's kind of the first thing. And then the second thing, and it's maybe a little bit of a divisive comment, but I sort of believe it, is that I really think that Ethereum has not been executing very well, especially in the past year or two or three, where ETH1 was amazing. Obviously, that brought smart contracts to the world for the first time. But more recently, I think they've really been out executed by a lot of the different roll-up chains. So things like Starkware, Optimism, those are kind of additive to Ethereum, but also Solana, Cosmos, Near, a bunch of the other ones, I think are executing a lot faster on the layer one infrastructure. And that's kind of opened the door for this multi-chain future that may not have necessarily needed to be the case if Ethereum executed better.
It might be worth explaining what Antonio is referring to there when he says ETH is not executing. So Ethereum right now, it's very, very similar to the way that Ethereum was, call it 3-4 years ago, when Ethereum was still in its infancy. And Ethereum has been trying to transition to a new version of Ethereum called Ethereum 2.0, but that transition has been extremely delayed. So initially, I was actually chatting with somebody about this the other day, that I think it was in 2014 that Vitalik thought that Ethereum would transition to proof of stake by 2016. And of course, now it's 2021 and we're still waiting. Maybe in mid 2022, we'll actually see the full proof of stake transition, but we're not there yet. And so Ethereum today, it does something on the order of 10 to 15 transactions per second, depending on how you count. And it's just incredibly obvious that that's not enough for all the demand that's surging through DeFi today. And there are a lot of different ways that people are trying to scale Ethereum by sort of building these verticalized scaling systems on top of it called rollups. But if you're just not going to scale Ethereum, then these other chains are popping up and saying, look, we are going to offer the same service that Ethereum does, but we're going to be faster, we're going to be newer, we're going to use better technology, and we're just going to do the full court press to bring on developers, give them a great ecosystem, and support them as they're building new projects. And now, that being said, Ethereum, Antonio, you built DYDX on Ethereum. It's on a roll up, but you're anchoring the whole thing in Ethereum. Why aren't you moving DYDX to a Solana or a Near or an Avalanche or whatever?
we're thinking about it. I sort of have like a counterculture view on this. Like, and I've said this before, but like some people, and I think a lot of people in crypto have sort of just like emotional or religious or whatever ties to a particular technology. I 100% don't care what technology DYDX is built on. I just want to offer the best possible product experience to our users. And a product experience in decentralized exchange means a lot of things. So it means what level of decentralization can you offer? What level of security can you offer? Scalability is important. Privacy is important. All these things are important, right? But all of product and engineering is trade-offs, right? So you have to think about how do you trade off against all of these different things. Right now, I do believe, and DYDX is currently built and sort of rolls up back to Ethereum, like you say. We're built on a layer 2 technology called zero-knowledge rollups in partnership with Starkware. And I think that gives our users a high amount of security and decentralization, but sort of at the expense of some level of scalability. So we're thinking about it, and if I believed that DYDX on a different chain would be better than Ethereum, we're sure as hell going to build it.
So with Cosmos, we actually have like a slightly different view of how the multi-chain or interchain will form. So one thing that's worth noting is Cosmos is not an L1. It's this idea of like, hey, we'll have many chains connecting to each other and like interoperating very seamlessly. And today that doesn't seem like a radical idea. Today that seems like obvious. But I guess 4 years ago when we started pitching this idea, that was like this very radical idea. And we were like, no, what are you talking about? Ethereum will scale and solve everything. But I think one thing that still differs slightly between like how I see the interchain forming and maybe what's still the more prevailing view is I don't see there being a world of going forward. I call this the multi-chain versus the interchain view. The multi-chain view is that, hey, we're going to have all these like L1 ecosystems, and applications that want to go multi-chain will have to deploy on all these ecosystems. So, SushiSwap is actually a great example of this, right? SushiSwap is like, basically redeploying their core contracts, core protocol across many, many different EVM chains, which I think can work. But in my opinion, I think that ends up, fragmenting your liquidity, causing a, worse UX when you're going cross-chain. The osmosis approach is more about some application-specific blockchains, where we believe that every application will want to be on its own blockchain. So osmosis isn't we're an interchain DEX, but that doesn't mean that our osmosis is sitting on many different chains. Instead, we have one osmosis chain that is then connected to many different blockchains. And then assets can come onto the osmosis chain, trade there, and then flow back to whatever their destination chain is. And, I think there's other protocols that have like similar idea. If you look at Compound is also taking this approach where they're saying like, hey, we're not going to go split across many different chains. No. Instead, we're going to go build Compound chain and have that be the single lending market across for the entire interchain world. And so and along with like, this like the lack of fragmentation, when you have your own chain, you also get a lot of control and benefits over that, where you get more, osmosis is sort of this like bet on vertical integration where other DEXs, they can control the application layer of their project. But for osmosis, we can control not just the application layer, but the protocol itself. And, all the way down to like the blockchain, we can change the cryptography that we use. That's what enables us to do a lot of the privacy innovations that we're doing that you just couldn't do on someone else's L1. We can do certain UX things. So for example, on osmosis, most blockchains, you have to pay transaction fees in the native token of the chain. But, we found that to be a bad UX and a barrier to entry for users. And so, we were able to modify the core blockchain to allow users to pay their fees in any asset they want. And so this is sort of, we believe that like every blockchain, every application will have different needs from the blockchain. And the best way to satisfy those needs is for each blockchain to have its own, for each application to have its own customizable chain.
But normally there would be some trade-off there around decentralization or security, right?
Yeah, so there's ways where you can have chains sort of share security with each other. So, there's this idea called shared security. We've been working on this idea called superfluid staking, which basically allows assets to be used in DeFi while also helping secure the chains themselves. And there's also this idea that, hey, we lose composability when we go into this cross-chain world, which I think is a little bit incorrect, where, look, if you look at web development, all of web development today is asynchronous, right? Like there's no synchronous programming system for web. And it's like, yes, it was annoying for many years, like, callback hell in JavaScript. But over time, we built the tooling and infrastructure where it's actually not that bad today, right? Like JavaScript has just developed to this point where it's very easy to build asynchronous applications. And it's basically just inevitable that it's a matter of getting the tooling there. But like writing asynchronous cross-chain applications will become as simple and easy as writing smart contracts on a single chain are today.
All right, so we're getting pretty close to time, and I want to try to start winding the conversation down because we've gone pretty deep on DEXs, but I know that a lot of people here, they're tuning in and they're trying to understand exactly what is going on in the space. Maybe they've played around a little bit with buying some crypto. Maybe they've heard that decentralized exchanges are a big deal. Dan, can you share with some of the folks here just like kind of the high level of how big this phenomenon is? Like how much money is going on in DeFi? How much in terms of users? How many users are we seeing interacting with this stuff?
Yeah, so the growth is.
Can you also tell us which dog coin to buy?
No idea. So yeah, I mean, DEXs have really exploded in use. I mean, we've been following them for a while. I think now total DEX volume is, depending on how you count it, is somewhere between $5 to $10 billion a day. And then there's more than $10 billion in assets just locked in the AMM protocols, basically providing liquidity for people to trade on. And that's, it's been like basically growing exponentially since for several years, and it's gotten to this really remarkable place. I've seen estimates that the number of actual users on DEX is over 500,000 daily.
Why do people still use centralized exchanges for crypto-to-crypto transactions? I'm not a big trader myself. I just tend to invest in funds, so I'm curious because, it seems to me to be more efficient to do it on a DEX.
If your assets are on a crypto exchange, if you're primarily a speculator and you're just investing, it makes sense to hold your assets on a centralized exchange and trade there because it's cheaper. So you do have to pay, like on Ethereum right now, it's like $20 a transaction to trade on Uniswap. That adds up if you're trading a lot. And if you don't actually want to use your assets anywhere, if you find just having them on a centralized exchange, then that's the cheapest place to trade. If you're buying an asset in order to use it on chain, in order to participate in something in DeFi, in order to buy an NFT, then you'd have to withdraw it from the centralized exchange anyway. And I think that's a big reason why DEXs have become really huge in the past couple of years. Is just a lot of stuff to do with assets on chain now. And so if you live on chain, if your assets are on chain, DEX is just naturally what you use. But if you're just trying to speculate on it, it's a good reason to. Yeah,
I see. So if you're farming, staking, buying NFTs, then you go out of the centralized exchange and into a DEX because you enter that self-custody world anyway. But
right.
If you're just trading coins to buy and hold, it's easier to do it through a centralized exchange, and they can just do it inside their own pool. They don't actually have to broadcast an on-chain transaction, which is pretty expensive these days for ETH. But right. DYDX has brought that down, right? And there are other roll-up-based and other like off-ETH DEXs coming. Antonio, what does it cost to do a trade on your platform?
It's free from a gas perspective. We just charge like fees that are really comparable to a centralized exchange.
So you're just basically eating it as profit. I love it.
Yeah.
Well, so the reality today is that, this stuff is still early. Like decentralized exchanges really started working last year. So it's still very, very new. And there's some things that you can get better pricing in DeFi, which is pretty amazing to my mind, because it used to be that everything was priced better in centralized exchanges than they were in DeFi. And now we're starting to see there are some things that actually you get better pricing and better execution in DeFi, but it's still a minority. And I think that is going to change over time. One, as DeFi gets more efficient, as we start finding both more efficient in terms of the gas and the fixed costs of interacting with these blockchains, but also just in terms of the mechanisms, to the point we were talking about earlier with automated market makers and Uniswap v3 and DYDX. Like, we're figuring this stuff out in real time. So I think it's going to look very different if you check back in 2 years as to which products are actually better priced in DeFi versus in the traditional centralized financial world.
As long as we're kind of talking about the future, should we just end with maybe everybody go around and make like a prediction 2 years from now? What's going to be different in DeFi?
Well, I think you have to start.
Oh, well, I mean, my bugaboo has always been privacy. I think privacy is going to have to make a re-entry into this whole system. And I think privacy-based DEXs and privacy-based chains and privacy-based approaches are going to be paramount. I agree with Tarun. It's a hard problem, especially with exchanges, in that because of composability, because some of this information has to be public, not everything can be private, but just understanding what those trade-offs are is going to be important. Also, obviously, but I think interchain is going to be really important. I think we're not only just headed into a multi-chain world, but a multi-asset world, and a world in which every coin can have a JPEG of an ape or a punk or whatever stamped on it and is differentiated from every other coin. So it's going to be, digital asset bonanza. That doesn't mean the Bitcoin maxis are wrong. You still want to hold a super scarce fungible asset as your reserve, but it also means that everybody who came in lately into crypto gets a chance to build something and play with something useful and new as well.
Before I answer the question, I'm going to answer Naval's previous question, which may have been a joke, but I'm going to take the opportunity to say it anyways. Which dog coin should you buy? The answer is obviously Dogecoin. Sergey can attest to this because we're working very closely with Sergey with the Axelar team on like getting Bitcoin onto Cosmos. But one of the requirements that we had, when we started working together was like after Bitcoin, the next thing you have to do is Dogecoin, because I still think that actually Dogecoin is very important from this like cultural standpoint, where I can go out onto the street today and ask a random person if they've heard of Bitcoin. They probably have. But I can ask them if they've heard of Ethereum. They probably have not. But they probably have heard of Dogecoin. And I think that actually is a very powerful like cultural value that like I think Dogecoin has brought in more people into crypto this year than anything else. Maybe NFTs are a close second. What I'm excited about for DeFi, though, is, I think Naval just stole the words out of my mouth. I think privacy and interchain are the two biggest things. And yeah, I guess my biggest bet would be I think more applications are gonna go break off onto their own blockchains. I had a bet with my friend Alex from like 2 years ago that within 3 years, Maker will be its own blockchain. And so that I basically have, I think, another year left on the bet. So I don't know. I think it's going to be cutting it close, but I think it's only a matter of time before we see more and more applications start to break off into their own application-specific chains.
Tarun, why don't you give us your last thoughts?
Yeah, so I definitely think maybe I alpha leaked myself a little bit, but I think the notion of a private bridge is still not fully defined, right? Like even in like the Cosmos IBC standard, you don't have like the full privacy guarantees that you might have within a single chain, like kind of like what Henry, who's in the audience, is building at Penumbra. He's built is like a very, very privacy focused DEX. And I think that to kind of analyze this idea that the application layer and the consensus layer are going to have to interact a lot more to provide privacy, I think we're going to see that being taken advantage of quite a bit in the sort of like app chain world or even like roll up world, where there will start to be some deviation in order to kind of get to the point where you can guarantee some amount of privacy against sort of adversaries who can try to infer your private information. And so that will be really cool because it will probably mean there's going to be architectures that are a hybrid of app chains versus pure layer ones. And we just haven't imagined them yet.
So my opinion on, I think, where we're going in the next few years, the biggest thing that decentralized exchanges still need to solve is product experience. Just go on and try to use any decentralized exchange, probably DYDX included. Though I do like to think that we've pushed forward what product experience on DEX looks like in a big way, but they're just not on the same level quite yet as centralized exchanges. And I think that's the biggest blocker to adoption. Fast forward a few years from now, and I think DEX products will look vastly different, will be vastly improved from a product and usability experience. I had to give an estimate of sort of where we're going in the next 2 years, next 5 years. I think 2 years from now, probably decentralized exchanges will be on the 25% of all total volume and trading volume in crypto mark. And then probably in 5 years from now, they're going to be greater than 50% of all the trading volume in crypto. And I really think that's going to be driven by a huge increase in product experience and usability.
Yeah, so I think we're going to be entering more and more of a multi-chain ecosystem, and I think interoperability across it is going to be pretty critical. And I think the reasons for that are, my views are pretty aligned with what kind of Sunny has said earlier. What I'm excited about is just seeing more and more interesting applications being built, and I think what we're going to start seeing is more traditional and like Web2 organizations going and building on top of these open systems and blockchains in order to establish trust for themselves. And I think we haven't seen that yet.
So it's always safest when you're making predictions, especially about somewhere as close as 2 years in the future, to just assume that things are going to stay the same. So my prediction is that I think in 2 years, Uniswap is still going to be the highest volume exchange. Some version of Uniswap will be the highest volume exchange on Ethereum L1. And this is designed not to antagonize anybody on this panel except Maki. But I agree with everyone else that I think, especially I think that DEX volume as a share of DEX versus DEX volume is going to continue to grow. But yeah, Uniswap is still going to rule Ethereum L1.
Maki, you got a rejoinder?
Yep. I think we're gonna. I mean, by the way, 2 years at this point is like predicting like what is happening in 200 years, in my opinion. But like I think we're gonna be seeing like more adoption of like ZK rollups. What DYDX has done on the UX, like even though Antonio was saying it's not, I think it's probably where everything is gonna be moving into. We're probably gonna see also like giant like like a derivative on Starkware or ZK Sync at some point for derivatives and so on. My opinion, like I think we're being too conservative. Like 50%, I think, like I don't see why all the big exchanges are not gonna actually be integrating DEXs in the future when they are like super scaled. That's actually like what I would love to see the most, and where we're gonna be moving into, like seeing like these giants kind of integrating DeFi as first class citizen is gonna be awesome. And from there, like it really blurs the line between like what is centralized, what is decentralized. So yeah, I think we're going to see just even more adoption, and I think we're going to be crossing like 10 million users in DeFi, like on the daily, in my opinion.
Okay, well, I'll wrap with my prediction. Is that Naval, you mentioned that you think there's going to be this explosion in different types of assets that are created in DeFi, and I think that the other thing that's probably going to happen is that there's going to be an explosion of assets that we already trade in the real world that are going to be recreated on DeFi. So in DeFi, we call these synthetic assets, which basically mean they're a derivative that tracks some underlying thing. So one of the biggest derivatives you see on chain today are actually synthetic dollars. And then you're starting to see things like synthetic Tesla stock, synthetic S&P 500. And at some point in the future, you are going to be able to, with just a mobile phone from anywhere in the world, buy any financial asset, no matter how small, whether you're a human being or a machine or an AI. And I think it's not going to be too long until we start to see that the effects that that's going to have globally, and it's going to be very significant. Right now, we're building the infrastructure for all that stuff, and right now it's mostly being used to trade ETH, Bitcoin, dog coins. But pretty soon, the exact same stuff that we're building is going to end up being co-opted to trade almost everything you could possibly imagine in the traditional financial realm, as well as the crypto native assets. So I think that wraps. Thank you everybody for bearing with us, and have a good evening, good morning, wherever you are in the world, and GM or GN.
Thank you everybody. Thanks for joining us.
Thanks guys. That was great.
Thanks for having us.
Thanks.